On September 22, 1985, five men slipped quietly through the side entrance of the luxurious Plaza Hotel overlooking Central Park in New York City. They were the finance ministers and central bank governors representing the world's five largest capitalist economies: the United States, Japan, West Germany, France, and the United Kingdom. They had gathered in strict secrecy under intense diplomatic pressure to engineer one of the most audacious and consequential currency interventions in modern financial history. To understand why these global powers took such radical coordinated action, we must examine the severe macroeconomic imbalances that gripped the global economy during the early 1980s. In 1979, Federal Reserve Chairman Paul Volcker launched an aggressive monetary crusade to extinguish double-digit American inflation by hiking benchmark interest rates above 20%. While this brutal monetary tightening successfully broke the back of American inflation, it created a massive, unintended shockwave across international financial markets. Global investors, multinational corporations, and sovereign funds rushed to convert their capital into United States dollars to capture these historic, risk-free yields on American government debt. This unprecedented wave of capital inflows drove the foreign exchange value of the United States dollar up by more than 50% against major world currencies in just 5 years. For everyday American consumers, a supercharged dollar created a golden era of cheap purchasing power, filling retail stores with inexpensive imported electronics and foreign automobiles. However, for American domestic manufacturers, heavy industrial producers, and agricultural exporters, the overvalued dollar proved utterly catastrophic. American machine tools, industrial equipment, construction machinery, steel, and motor vehicles became prohibitively expensive on international markets, while foreign competitors easily undercut domestic producers at home. Across the American Midwest, factories shuttered their doors and unemployment surged, creating the industrial crisis that permanently came to be known as the Rust Belt. Iconic American industrial leaders like Caterpillar and Bethlehem Steel reported devastating quarterly losses as foreign buyers canceled orders in favor of cheaper international alternatives. Meanwhile, across the Pacific, post-war Japan had transformed into an unstoppable manufacturing superpower, producing superior semiconductor chips, consumer electronics, and fuel-efficient cars. Japanese corporations, led by titans like Toyota, Sony, and Panasonic, captured dominant market share across North America, generating massive bilateral trade surpluses. As the United States' merchandise trade deficit ballooned to historic heights, intense political fury erupted on Capitol Hill in Washington. American lawmakers began drafting aggressive protectionist legislation, openly threatening sweeping 25% tariffs and restrictive import quotas against key allies, especially Japan. Bipartisan coalitions in Congress warned that if the White House did not take immediate executive action, legislation would pass to close American ports to foreign imports. Fearing an all-out global trade war that could shatter the post-war free trade architecture, the newly appointed United States Treasury Secretary, James Baker, decided that currency markets had to be actively restructured. Baker understood that traditional market forces alone would take years to correct the imbalance, during which protectionist tariffs might irreversibly damage global commerce. He engaged in delicate back-channel diplomacy with Japanese Finance Minister Noboru Takeshita and West German Bundesbank President Karl Otto Pohl to lay the groundwork for a coordinated multilateral intervention. Inside the ornate French Renaissance meeting rooms of the Plaza Hotel, the G5 delegations engaged in hours of tense, high-stakes negotiations over precise intervention targets. The resulting historic agreement, formally signed and released as the Plaza Accord, carried profound implications beneath its measured diplomatic language. The official joint communiqué declared that exchange rates should better reflect fundamental economic realities and that an orderly appreciation of non-dollar currencies was highly desirable. Behind closed doors, the five central banks committed to a coordinated strategy. They would unleash up to $18 billion in direct foreign exchange interventions to actively force down the dollar. Furthermore, the United States promised to reduce its federal budget deficit, while Japan and West Germany agreed to stimulate domestic consumer demand and open their domestic markets to imports. When global foreign exchange markets opened on Monday morning, the impact of the Plaza Accord was immediate, violent, and far larger than its architect had anticipated. Currency traders realized that the world's most powerful central banks were acting in absolute unison to push the dollar downward, triggering massive speculative selling across every major financial hub. Over the next 24 months, the United States dollar plummeted by more than 40% against both the Japanese yen and the German Deutsche Mark. In Tokyo, the foreign exchange rate shifted with breathtaking speed, falling from approximately 240 yen per dollar before the accord down to nearly 120 yen per dollar by 1987. For the export-dependent economy of Japan, this sudden doubling in the external value of the yen triggered a severe economic shock, known locally as Endaka, or the strong yen recession. Japanese industrial giants saw their export profit margins evaporate almost overnight as dollar-denominated revenues shrank dramatically when converted back into domestic yen. Small and medium-sized component suppliers across industrial manufacturing hubs in Osaka and Nagoya faced imminent bankruptcy as major exporters demanded steep price cuts. Facing panic from corporate executives and mounting political pressure from industrial lobbies, the Bank of Japan decided to take aggressive countermeasures to rescue the economy. Under the leadership of Governor Satoshi Sumida, the Bank of Japan aggressively slashed its official discount rate through 5 consecutive cuts between 1986 and 1987. Benchmark borrowing costs plummeted from 5% down to a historic low of 2.5%, making credit cheaper than at any point in modern Japanese history. Simultaneously, the Japanese government unleashed massive fiscal stimulus packages, pouring trillions of yen into public works, transportation infrastructure, and regional construction projects. In February 1987, the major powers met once again in Paris to sign the Louvre Accord, attempting to halt the dollar's freefall, but the monetary floodgates in Tokyo were already wide open. Instead of merely stabilizing factory output, this torrential wave of ultra-cheap liquidity collided with a newly deregulated and highly competitive Japanese commercial banking system. Following financial reforms encouraged by Western trade negotiators, Japanese commercial banks had lost their monopoly on corporate bond underwriting. Suddenly awash in excess central bank liquidity and facing relaxed regulatory oversight, commercial banks began aggressively hunting for new lending avenues. Because traditional blue-chip manufacturing corporations had reduced their domestic borrowing, commercial banks actively incentivized real estate developers, small businesses, and ordinary citizens to take out massive loans. Crucially, Japanese lending practices relied almost entirely on real estate collateral rather than rigorous cash flow analysis when approving commercial loans. This structural mechanism ignited a powerful, self-reinforcing speculative flywheel. Rising land prices allowed property owners to borrow more money, which was immediately plowed back into buying more real estate and equities. Within months, Tokyo became the epicenter of the largest and most astonishing speculative asset bubble in modern financial history. Commercial and residential real estate values across Tokyo doubled, tripled, and in prime central districts multiplied tenfold in less than 4 years. Corporate boardrooms transformed into speculative trading desks, practicing what became widely known as Zaitech, or financial engineering, where trading profits from stocks and land dwarf core operating revenues. Corporations established specialized investment vehicles known as token funds, pouring excess cash reserves into the stock market to inflate their quarterly earnings reports. By 1989, the theoretical land value of Tokyo's Central Chiyoda ward alone exceeded the total estimated real estate value of the entire nation of Canada. At the absolute zenith of the mania, the 3.4 square kilometer grounds of the Tokyo Imperial Palace were valued higher than all the real estate in the entire state of California. Speculative euphoria quickly engulfed the Tokyo Stock Exchange, propelling the benchmark Nikkei 225 index to dizzying heights. Japanese price-to-earnings ratios soared beyond 60 and even 70 times earnings, compared to historical averages of 12 to 15 times in Western equity markets. Flush with seemingly limitless paper wealth, Japanese conglomerates and high-net-worth investors embarked on an aggressive international shopping spree, acquiring iconic trophy assets across the globe. Japanese buyers purchased New York's historic Rockefeller Center, the world-famous Pebble Beach golf resort in California, and major Hollywood entertainment studios like Columbia Pictures. In the international art market, Japanese corporate collectors paid record-shattering fortunes for European masterpieces, including Vincent van Gogh's iconic sunflowers and portrait of Dr. Gachet. Back home in Tokyo, elite golf club memberships were traded on dedicated financial exchanges like liquid commodities, with individual prestigious memberships trading for upwards of $3 million each. Yet underneath this dazzling facade of infinite wealth and economic invincibility, the underlying economic foundation had become completely detached from reality. Average working-class families in Tokyo found themselves permanently locked out of homeownership, as modest suburban apartments cost more than 20 times an average annual household income. Commercial banks even began offering multi-generational, 100-year mortgages, effectively passing housing debt down from parents to children and grandchildren. Rental yields collapsed below 1%, meaning that property investments could only be rationalized by the speculative belief that land values would rise forever. Alarm bells finally began ringing inside the upper echelons of the Bank of Japan as senior officials realized that rampant asset price inflation threatened basic social stability and banking solvency. In December 1989, a newly appointed central bank governor, Yasushi Mieno, took office with a determined mandate to pop the speculative bubble before it grew any larger. The Bank of Japan abruptly executed a series of aggressive interest rate hikes, rapidly raising the official discount rate from 2.5% all the way to 6%. Simultaneously, the Ministry of Finance introduced strict quantitative restrictions on total real estate lending, capping the growth of property loans across the commercial banking sector. The sudden, aggressive withdrawal of monetary liquidity pulled the structural foundation out from beneath the speculative pyramid. On the final trading day of 1989, the Nikkei index closed at an all-time record peak of 38,915 points. When trading resumed in January 1990, the Japanese equity market began an agonizing, catastrophic collapse that would last for years. By late 1990, the Nikkei index had plunged by nearly 50%, wiping out trillions of dollars in paper wealth and devastating corporate balance sheets. Commercial and residential real estate prices followed shortly after, initiating a relentless, grinding 15-year bear market that saw prime urban land lose more than 80% of its peak value. Because Japanese commercial banks had issued astronomical sums in loans backed by overvalued land collateral, the real estate crash triggered a catastrophic banking crisis. Specialized housing loan companies, known as Jusen, collapsed under mountains of bad debt, requiring painful government bailouts. Major financial institutions found themselves holding hundreds of billions of dollars in non-performing bad loans. But rather than recognizing the losses and restructuring, banks concealed their insolvent balance sheets. This regulatory forbearance created legions of insolvent zombie banks and zombie corporations, kept artificially alive through emergency loans and regulatory leniency. With corporate balance sheets deeply underwater, Japanese businesses completely stopped borrowing and investing, focusing every yen of operating cash flow on paying down legacy debt. This phenomenon, later formalized by economist Richard Koo as a balance sheet recession, neutralized standard monetary policy. Even after the Bank of Japan slashed interest rates all the way to zero and eventually introduced experimental quantitative easing, private sector credit demand remained completely unresponsive. The structural aftermath of the bubble's collapse ushered in decades of persistent economic stagnation, mild consumer deflation, and stagnant real wage growth known universally as Japan's lost decades. To offset collapsing private spending, the Japanese government ran massive fiscal deficits for decades, building roads and bridges while driving public debt past 250% of gross domestic product. The dramatic history of the Plaza Accord and its aftermath provides vital, enduring lessons for modern investors, central bankers, and macroeconomic analysts. First, it proves that coordinated political interventions in foreign exchange markets carry immense, unpredictable secondary consequences that can destabilize entire national economies. Second, it demonstrates that when central banks suppress interest rates to neutralize currency strength, excess liquidity inevitably leaks into asset markets, creating dangerous speculative bubbles. Third, it highlights the immense danger of using aggressive monetary tightening to pop an established asset bubble without having robust bank recapitalization mechanisms in place. Many of the unconventional monetary tools used by central banks around the world today, from zero interest rates to forward guidance and balance sheet expansion, trace their origins directly to the lessons learned from Japan's post-Plaza Accord trauma. Understanding this pivotal chapter of economic history allows us to recognize how geopolitical currency agreements can reshape the economic destiny of great nations for generations to come. Please keep in mind that this analysis is presented strictly for educational and historical purposes and does not constitute financial, investment, or legal advice. Always conduct your own thorough independent research or speak with a licensed financial professional before making any investment decisions. If you found this deep dive into monetary history valuable, please like this video, share your perspectives in the comments,